Prasanna sir also joined.
Yes.
List of the
Sir, good evening, sir. Prasanna sir. Prasanna
Good
sir.
evening, Kishore garu.
How are you, sir? I hope you
are going on. I'm in Chennai now.
Yes, sir.
I'm just going to the airport.
Right, sir. Vivek sir, speaker of today's session, and also Amit sir, speaker on 15th, has also joined us, sir.
Very nice.
It's 6 o'clock, and we will start the program in 2 minutes or 3 minutes. We will have a address from you, sir.
Okay, no problem.
Right. Thank you, sir. Speaker sir, Vivek sir, with your permission, shall we start the meeting?
Let's get started.
Sir is also with us. Yes. Good evening, friends. You are all welcome to this series of sessions, 3-day sessions virtually on international transactions and also taxation of the NRIs, as well as transfer pricing. A host of topics will be dealing all these 3 days, every day from 6 p.m. to 8 p.m. Friends, we will start today's session with our motto song. We need not stand, but we can place our hand on our heart as a mark of respect. Give me a second to play the motto song.
येष सुप्तेषु जाग्रति येष सुप्तेषु जाग्रति कामं पुरुषो निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यति कश्चन एतद्द्वैता
Yes, thank you. Now, a quick word of opening remark from our Vice Chairman of Vijayawada branch, CA Narendra Babu V. Over to you, sir.
Yes, I'm happy to welcome you, Vijayawada branch, for the 3 days virtual session on FEMA and international taxation of Vijayawada branch. And we are going to be learning 3 days in the 3 topics of different areas, which is relevant to the young members and the senior members. It is a new area of practice. Definitely, it will be help to a lot of professionals. And it is the Vijayawada branch is always planning to young members and a lot of members who are waiting for the new areas. Okay, in those 3 days, today and tomorrow and day after tomorrow, because today Vivek Razu garu from Hyderabad, in the area of investment by NRI in shares, real estate in India, and in India for Indian firms and companies, and also investment by Indian resident in shares and real estate in abroad. And tomorrow also we are having a session with a speaker of CAK Pradeep Garu from Hyderabad, FEMA and TDS compliance on international payments on current account with focus of 15 CA and CB. And day after tomorrow and 15th of June, CA Amit Rastogi, Gurgaon, from Gurgaon, first balance sheet and IT return of NRI of repatriation. Today, friends, we are also today chief guest of CAD Prasanna Kumar Garu from Central Council is also with us. We'll listen from him from about the Central Council activities and branches and activities, as well as with this, I welcome all of you to Vijayawada branch sessions. Thank you, sir. I am handing the proceedings to the secretary, sir.
Yeah, thank you, Narendra Garu. Let us listen to CA Prasanna Garu. CA Prasanna D is a Central Council member. He is from Visakhapatnam. He is in the Central Council for the 2nd term. and he is almost on all the non-standing committees and 3 standing committees of ICA. He requires no introduction. I hand it over to you, sir. We are eager to listen to you.
Yeah. Thank you, Mr. Ravi Krishna and C. Narendra. So, my dear participants in today's seminar. So, good evening to all of you. It's always a proud privilege for me to participate in the event which is organized by Vijayawada branch of SARCFI. As you know, any program we plan and disseminate the knowledge among all the participants. Any program, the moment the participant goes out of the hall, so you will have a lot of immense satisfaction that he has got a lot of value addition to the deliberation that took place in Vijayawada branch. And the way in which they structure the program, the way in which they give a practical approach to the entire presentation, the way in which they choose the speakers is exemplary and is very useful. That is the reason why, when the number of participants post-COVID and during the COVID has come down drastically, because knowledge is available in the electronic media in many ways. Many stalwart speakers are speaking in many forums. Head offices are organizing many programs on different topics of importance to the practicing chartered accountant, particularly small and medium practitioners. Given the situation, there are a number of branches when they organize a program. Less than 100 is the number that we get, because knowledge is available in many forums nowadays. In spite of that, when Vijayawada branch organizes any program on a repeat nature also, a second time on the same topic also, the number of participants is the highest. That is what, is not only my comment, because I am closely attached with the branch. It's not only my comment. Many speakers, many council members who visited, who participated in the Vijayawada branch program, they say this one. It's very much commendable. I compliment the branch by managing committee after managing committee for carrying the same legacy and thirst for disseminating knowledge amongst the practitioners. Today is a special day for you, because we are going to discuss about FEMA. FEMA is very much important for Vijayawada. I'll tell you why. And also international taxation. It is said, but I don't know, even today it may be true. Every alternate house in Vijayawada, particularly Krishna district, and now the NTR district, so somebody is there abroad. Not only today, this has been the word that we used to hear since the 1970s. Many have settled abroad. Given the situation, lot of investments are happening from abroad in Krishna district, or rather in India, and vice versa also. That's also happening nowadays. Many people are trying to settle down abroad by selling their properties in India and repatriating the money, funds to their destination. This is what is happening. Given this situation, it is very much relevant. This topic is very much relevant. Almost every practicing chartered accountant in Vijayawada will have some client or other who is settled abroad. Maybe their children are settled, parents are settled, their relatives are settled. Lot of movement of funds is happening to and fro. All these things are very much relevant for you practitioners. And the type of speaker that have been chosen, I've seen the likes of Vivek Raju, and I've seen the other speakers also. The structure in the program is so well done, and speakers have been chosen who have got a lot of, there are renowned speakers and stalwart speakers have been chosen. I'm sure by the end of this 3-day session, after 3 sessions, you will have enrich yourself with a lot of knowledge required for your practice. And as you know, today the buzzword of the entire world in the audit function is the quality. Quality has to be ensured. Even be it a small certificate you give, be it a small report you give, on wherever you sign, your signature carries value, like you said. The quality need to be ensured. I'm sure with the knowledge that is going to enrich during the 3 days, so you will certainly enrich yourself and see the quality audit and the quality service are rendered to the clientele or the stakeholders. So with this, I compliment the Vijayawada branch to in the spree to enrich knowledge in the minds of all the small and medium practitioners in that particular area. And wish you all the best. And I thank the management for giving this little opportunity to interact with this occasion. Because I am traveling in the car, I wanted to speak about a couple of issues, but I thought this is not the time. So anyway, next occasion, whenever it comes, deliberate on those 2 issues, which will be of relevance to all of you. With this, thank you very much once again. Wish you all the best.
Thank you. Thank you very much, sir. As always, whenever we invite, wherever you be or whatever engagement you have, you definitely find some 5 minutes or 10 minutes to join us virtually and give your address. Thank you very much,
Yes,
sir, for those sweet words. Of course, these
you.
types of words will definitely encourage us to do lots of programs in the future.
Yes.
Of course, sir, there are people who will try to catch the running bus. We have 288 registrations of non-ERS, and ERS we have 200 members in
Yes.
ERS, sir. So we
Good,
are a good number of participants. By this time, we are already joined by more than 150. It's in fact, it is 167.
167.
167. We hope some 50, 60 members will definitely join. Of course, people will come and go, and also they have the luxury of watching it on YouTube at the time of their convenience.
Yes.
Thank you, sir. Thank you very much. We'll let you go. And friends, we will continue with the program. Before the speaker, I hand over the proceedings to the speaker, sir. Let me say a few words about today's speaker, Raju, sir, who is from Hyderabad. Give me a second. Vivek Raju is a chartered accountant and a cost accountant and has 18 years of experience across IT, telecom, pharma industries. He is currently the CFO of Value Labs, an IT service and consulting company with close to 7,000 employees. He has worked in the past with companies like Aditya Birla Group, NTT Data, Novartis, etc. across all areas of finance, spanning financial reporting, GAAP compliance, taxation, treasury, management reporting, secretarial compliance, and governance. For his tenure in the industry, he had worked on all the three financial reporting frameworks, IFRS, US GAAP, and Ind AS. He has also deep understanding and exposure pertaining to direct taxes, international taxation, transfer pricing, treaty interpretation, FEMA compliance, and business valuation. He contributes to the Chartered Accountant Journal of the Institute and other journals in the field of finance on topics related to accounting and taxation. He also speaks at various seminars of the Institute and other CFO forums. One such is today's program. Sir, over to you to take this program forward.
Thank you, sir. Thank you, Ravikeshwar Garu, Secretary, and Narendra Garu, Vice Chairman, and Srinivas Garu. Thank you very much. And also Sikasa Chairman, Jayant Garu. Thank you very much for giving me this opportunity. So what we will do is, I have a brief presentation. I will go ahead and present that. So we will, I think, take about 1.5 hours to 1 hour 40 minutes, I believe, to complete the presentation. If we can complete that earlier, we will try to do that. And after that, we will maybe have a 15-20 minutes of Q&A session in the interest that, participants may have questions and we can answer those questions. If after the timeline also we have certain questions, maybe they can send it to the conveners and we can take those questions offline, sir. So should I get started, or shall I present the PPT, or maybe I have sent it earlier? Would someone be presenting, sir?
Sir, you can do it on yourself, and also participants will request you to share the PPT. Friends, I would inform you that the speaker, sir, has already forwarded the PPT to us. Once the session is completed, with the permission of the speaker, sir, we will be able to share in the WhatsApp group created, as well as to your mail IDs. We'll do that definitely once the session is completed. Over to you, sir.
Okay, good evening, friends. So what we want to do today is cover FEMA and international taxation. So the topic is about, what are the FEMA related compliances of Indian residents and NRIs specifically. So what we do is this presentation is done in two parts. The first part being, sorry, someone is raising a hand, I believe. Okay, so the first part is about.
So sorry to interrupt you, sir. Some of the participants feel that your voice is not that much clear.
Okay, let me try.
Are you using a headphone set like that, sir? Mic, or is it a computer mic, sir?
Computer mic, sir.
Some are feeling that the voice is not that much clear. So if you can try to fix that.
Oh, is that? Let me see how I can do that. Okay, shall I log in again, sir? I'll drop out.
Definitely, you can do that, sir.
Give me.
Ramesh, Vivek sir will be logging out. Once he log in again, you make him co-host. We have an entry with Vivek Raju. Ramesh, if you can hear me, can you make Vivek Raju sir co-host? I do not have the permission, I suppose. Okay, right. Sir, Vivek sir, you can unmute yourself and you can speak, sir. And also, I may advise you that you please log in with only one connection, sir. At your end, I request you to go with only one connection, sir, not multiple connections.
Vivek sir, please unmute yourself, then you can speak.
Am I better right now?
Yes.
Yes, sir. Yes, sir. May I also request you that you log in from only one connection from your end, sir. Please don't use multiple connections. If any other connection is there, you please log out, sir.
I think I have logged out. Let me just give me a moment.
Now it sounds better, sir.
Okay, sure, sir.
Fine. Please go on, sir.
Sorry for the inconvenience.
No problem, sir. No problem.
Okay, can you present this thing, because I don't have it in my system right now?
Yeah, give me a second, sir. I think I need to download it straight away. I will do that. In the meantime, you can start, sir, please.
Okay, so in this presentation, today's session, we actually divided it into two parts. The first part being about non-residents, basically because the compliances on non-residents are a lot more complex than what we do for residents, particularly when it comes to individuals. So the first part of it, I think about major part of it rather we actually dedicate towards knowing what all NRIs can do in India, what all they can invest into India, what is the way of doing it, and also because it is not just about investing, but once they actually invest in India, how is it that they take money out of India? Because normally people come, there are two ways of investing when people come to India. The first one is they actually have a connect with the homeland and then they want to buy property and everything in India. The second kind of people you see are the second generation or the third generation people that have moved from here, right? They are mostly interested in earning some kind of a return which is not available in developed economies. So that is where we see people who actually invest in a repatriable basis, because for them, this is only an investment. It is not something that they want to hold permanently in India. So with that, actually, we go for the presentation. I will take you through the presentation now. So can we put the presentation on?
Ravi sir, unmute and speak.
Yes, sir. I am almost there. Give me a second. Hope it is visible now, sir.
Yes, it is better. Yeah, let's go to the first slide. Okay, so basically, let's go through some facts, very quick facts before we start this thing. What is it that NRIs do for the Indian economy? If you see, we have approximately 32 million of Indian diaspora spread across the globe. Most of them, if you see, are in certain GCC countries. But if you see, mostly you also find them in English-speaking countries like US, UK, Canada, and Australia. These are the latest set of people who have gone in the 90s and 2000s. One thing, if you observe also, is the kind of remittances that come to India. India actually tops on the remittance charts every year. Last year, we have seen about $83 billion. Sorry for the mistake there. It is $83 billion in remittances from different countries that NRIs have sent across to India. And this actually forms close to about 2 to 3% of the GDP. So the contribution of NRIs to India is really, really high. And if you see the small graph over there, it actually gives the remittances by the state, where Kerala obviously tops the charts when it comes to the remittances inwards. AP, which Andhra over there, which also includes Telangana for that matter, is coming somewhere around 1/4 of what Kerala does. Predominantly, if you see, the kind of why remittances are low in AP, despite a significant diaspora who is there in the US, is basically the kind of population that emigrates from Kerala to GCC is the kind of people who don't want to settle there. Some point of time, they will have to come back, so they actually remit money to India, either to buy assets or for the maintenance of the families. But the kind of people that go out of Andhra Pradesh or even Karnataka, for that matter, would be people who actually want to settle there and make their livelihood, and they may not even want to return back. So remittances in those cases would be lesser. So that is why you see that the kind of a disparity between states like Kerala and all versus what you would see for the remittances when it comes to Andhra Pradesh. So again, if you see, AP accounts for approximately 4% of the remittances that come to India, and remittances do form from NRIs do form a significant part of the forex. And RBI has actually presented some statistics on what all the remittances have. 60% of the remittances for the maintenance of family, basically the family who is here, they just want to have the family supported from onshore. The dollars, basically, they come back. Predominantly, these kind of remittances will be from GCC countries. Deposits in banks, these are basically, if you see the geography that we are looking at, that 20% would mostly be English speaking world, like UK, US, Canada, or Australia, kind of it. Investments and others are the remaining 20% of the remittances. That is how RBI has actually classified, because when RBI gets the inward remittance, it actually gets, along with the SWIFT code, you will actually have a particular use end use. So the category by the remittance is made. Based on that, they do collect some high-level statistics, and these are the figures that RBI has actually published on the percentage front. Next slides. Okay. So let's see what a person resident in India is and who is a person resident outside India. RBI does not, or the FEMA Act, FEMA 99, does not actually describe anything like a person resident outside India. It's basically a negative definition they give. So they describe a person resident in India, and whoever is not resident is a person resident outside India. Okay. So if you see a person resident in India, what they say is anyone who is living in India for more than 182 days in the previous financial year. So there is a cutoff 182 days and more during the previous financial year. First, you qualify as a resident in the current year. Okay. The next one, they actually exclude these type of people who. So even though last year you have been there for all the 365 years, but say on today, 13th of June, you have gone out of India for employment, or you have actually want to set up a business, and so you have gone out of India, or say someone has their children outside India, so they want to go outside India and they want to stay there. So these type of people who actually are going out either on a employment or on to do some business or any other purpose that actually has some kind of a permanency, they want to exclude out of the definition of a resident. I'll tell you, if time permitting, why they are excluded. That's something which RBI wants to favor people, so they have actually excluded them because they don't want people going outside India to be treated as residents, and they actually observing all the compliances that a resident has to have, particularly when they are outside India. So they actually excluded all those people who completely left India, at least for a reasonable period of time. You don't even expect them to come back. On the non-individuals front, the first one is even a company can be a resident in India. So any company which actually is incorporated and registered in India automatically by default becomes an Indian resident. So there is no doubt about that. Okay, then you don't have something like, like income tax, place of effective management kind of it. Nothing is that. The moment you are incorporated in India, you are a resident Indian. You are called IR, Indian resident. Any branch or office or an agency that is controlled by an Indian company or an Indian partnership firm or even a sole proprietor, if they actually sets up something outside India, those are also. So any entity or any, I would not say an entity, any agency or a branch which is set up outside India, but the control happens from India, that is also considered to be a Indian resident. Okay, and on the flip side, what they said is the moment you are in India, you are a branch or an agency of a foreign company, even then you are considered to be a resident in India. So it's a definition which they have made it pretty wide. You incorporate in India, you are an Indian resident. You are a branch or an agency or a project office, there's an office of an Indian resident, you are still resident in India, though you are there outside India. On the flip side, if you are a branch of a foreign company or a partnership or anything, but you are doing business in India, you are considered to be a resident and you will have to abide by FEMA. So that is how they have described it. And if you don't fall in any of these things, then obviously you are not considered to be a resident. And any person who is not a resident is actually a person resident outside India. Next slide. Okay, so even in non-residents, particularly when we actually take about most of this, if you see most of the presentation, we will be talking about individuals, because what we are looking at is the compliances with respect to individuals and NRIs when they are actually coming back to India, or people going out of India, what they'll have to do. So there are three categories of non-residents. The first one is the non-resident Indian citizens. These are the NRIs. Okay, they still carry the Indian passport. Okay, they go out of India, but they go out for a long period of time. They are not resident in India. So these are considered to be non-residents. Not someone, again, it's not someone who goes on a holiday for 7 days or 1 week and all, but these are the people who actually go to take up employment outside India. Okay, and again, if you are going on a business visa and you work there for 2 to 3 months, also you are considered to be a resident, because what FEMA looks for is an uncertain period of time. If you are going on a 3 months visa, it is not an uncertain period of time. So you would still fall under a resident Indian, even if you are going on a business visa, and if you do some work outside India, you are still a resident Indian. Person of Indian origin, we will actually see what the person of Indian origin is. Basically, these are people who are earlier citizens of India, say someone who has actually born in India, educated in India, but goes outside, say to the US, after some point in time applies for a PR and gets a citizenship. Those are not the first category Indian citizens, but they actually fall under Pio, and they actually are, in most of the FEMA clauses, they are treated at par with the Indian citizens. They are not being discriminated. So they almost enjoy the same facilities and the same benefits that the Indian resident NRI, not an Indian resident, but actually an NRI enjoys. The last one is non-resident, non-Pio. This is actually the last category where the person has no connect with India. Could be some completely an American citizen or some European and all. So that person comes to India and does something. We are looking at that. Those are the people who are actually non-residents and also not a NRI or a PIO category. They actually don't have the same kind of flexibility or the benefit that you would actually have. Okay, so if you really want the definition of what a PIO will be, you will have to see the definition, which actually says it is the definition is governed by the Government of India Act 1935. This is an act, if you see, this actually is an act which was enacted even before the Indian independence. It is passed by, the imperial government at that point in time. This act was passed in London. This was the first time that a government structure was defined in India. And, they actually said how a federal government should look like, and how a state government and the provincial government like Madras, Bombay, and these are all provinces, right? So they actually said how a provincial government should look like. And at that point in time, what they actually said is who is a resident is what they have mentioned in that particular act. If you want a copy of this act, ironically, you will find this copy in the archives of the British Parliament. Even someone can Google that, you will still find a copy of it. So what they say is anyone born in this entire India at that point in time, India includes even what we call the present day Pakistan and even Bangladesh. So anyone born in this entire geography is considered to be a person resident in India, and they have to permanently reside. So it's not that they were born there were actually British citizens who used to come here and they had children and all, but they were not residents in India even by that act. They actually, because there was no permanency for them. Spouse of a citizen of India or a PIO also. So even if someone is actually even not connected with India by any chance also, if that person marries an Indian resident or even an Indian citizen or an NRI or a PIO, that person obviously becomes a PIO and they can actually have a PIO. Now, one exclusion that they have done, if you see, is not just in the definition of a PIO, but across FEMA. Every single place, if you see, there is a separate carve out when you are dealing with nationals of Pakistan, Bangladesh, Afghanistan, mostly Pakistan and Bangladesh, but in some other cases, you will also find Afghanistan, China, Iran, Bhutan, Sri Lanka, and Nepal. Because so these are the countries around Indian, subcontinent, or the country as we call it, and they want to place some restrictions on these people because there is kind of a mobility around, and they also look the same. So to avoid having them misuse the benefits that are given under the act or the relaxations that are given under FEMA, so they are actually carved out. They will, particularly if you see Bangladesh and Pakistan, every single transaction they want to do, they have to do only with an RBI approval. There is nothing Pakistanis and Bangladeshis can do in India without RBI approval. And very, very recently, companies from China, even Hong Kong for that matter, Nepal and Bhutan have also been added in 2020 after, NDI has been amended. Next slide. Okay, so what we'll see is if you see FEMA is a very small act, mostly about 49 sections you will have. What we will see for investment is two sections, section 6 on capital account transactions and section 8 dealing with repatriation. Okay, one golden rule that we will have to understand in FEMA or keep in mind is that any current account transaction is permitted. Okay, unless it is specifically restricted. So you can actually take any current account transaction as permissible unless RBI specifically says or the FEMA Act specifically specifies that these are some things which are not permitted. Otherwise, if there is no restriction, that is possible. But on the other hand, if you see, capital account transactions are something where you will actually have to, RBI will have to specify saying that this is permitted. If RBI has not specified that this is a permitted transaction, you will have to assume that that is not permitted. In that case, you will have to go to RBI for an approval. Okay, so there's nothing. So it's a completely different thing, but on a current account transaction versus a capital account transaction. The moment and majority of the cases where you will find non-compliances is on the capital account transactions. Huge compliances always happen only on capital account transaction. Very, very small, non-compliances you can see here and there on current account, like not filing, the requisite forms and all. But on capital account transactions is where you will have problems when in case of non-compliance. Maybe next slide, please. Okay, so what we'll go through is when we are talking about NRIs, right? The first thing that we will have to look into is what is it that they can do in India. And normally you need a bank account to do any transaction in India, right? Even if you have to make a remittance and all, you need a bank account. So very, very high level, you have three types of accounts. Earlier, there were different other accounts, but RBI has actually discontinued all those accounts. But now you have these three main types of accounts: NRE, NRO, and FCNRB. NRE is non-resident external, NRO is non-resident ordinary, and FCNR is foreign currency non-resident. Because there used to be an A earlier, they actually made it a B, so there's nothing that B can abbreviate for. So if you see NRE, NRIs and PIOs can open such an account. NRO, any person resident outside India, so even a foreign citizen can open NRO account. And FCNRB is also an NRI and PIO. And one thing you can actually see in common between an NRE account and FCNR is most of them, or rather both of them, are common, more or less common. If you were to ask what is the difference and why RBI has introduced these two accounts, is NRE is a rupee denominated account and FCNRB is actually a foreign currency denominated account. That is the major difference between these two. All the others, if you see, more or less the same. Both of them, you can actually fund in dollars. And their balances here are freely repatriable then without any limit and all. So if you see where to open, your AD banks open these accounts. Currency, if you see NRE and NRO are INR accounts. You cannot open a foreign currency account in NRE and NRO. FCNR you can actually do in freely convertible currency, basically approximately 7 to 9 currencies depending upon the bank. Basically, you will have US dollar, Canadian dollar, euro, British pound, Japanese yen, Hong Kong dollar, and Australian dollar. Some banks do offer Singapore dollar and Swiss franc also. The others don't. So it depends upon the bank, who is offering this what currency. But otherwise, the major currencies, yes, every bank offers. The type, everything is NRE and NRO are basically savings or current. And FCNR, one other thing is it's only a deposit account. It's not a current account. It's more like, you get dollars, but instead of actually depositing them in the US, you deposit them in India. You can do FDs in all of them. Repatriable, this is the major difference if you see in these accounts. NRE and NRO are fully repatriable. Every single last dollar in the account, you can take it outside India. NRO also you can do, but there are some restrictions which kind of make it repatriable for many people unless you are an ultra high net worth individual. It is repatriable because every year you can send up to $1 million from an NRO account, which is roughly about 7.8 to 8 crores depending upon where we see the rupee at in the next week or so. But otherwise, if someone is looking at sending about 8 crores every year, normally you should be a high net worth individual kind of it. So unless you are a very high net worth individual, NRO also serves the purpose like an NRE and FCNR. Otherwise, a fully repatriable, yes, NRE and FCNR, you can do it. One other thing that you see in the NRE and FCNR accounts are that the interest that you get is not taxable. If you see Section 10, subsection 4 of the Income Tax Act, you will have a subclause 2 over there, if you were to see your Income Tax Act, there it actually says any amount which lies to the interest on any amount that lies to the credit of an NRE account is not taxable. So many non-residents actually, if you, again, to come back, why should someone actually get interest, or why should someone deposit in an NRE account for a non-taxability? If you were to see the normal currency interest rates, how it works, the interests on normal in developed countries, normally on a US dollar or yen or even euros, you will hardly have about 0.1 or 0.2%. Maybe now that the interest rates are going up, maybe it may go to 0.5 or 1% per annum. But India has always been, INR deposits have always been about 4.5, 5%, right? So to take that interest rate advantage, normally people do maybe tempted to actually take their surplus fund in USD and send it to India, convert it into INR, and actually invest in a savings account that gives a higher interest rate, and particularly the entire interest is tax-free. So that is one of the advantages that you have in an NRE account. In the similar thing for FCNR account, though it is not taxable, but you are depositing in foreign currency. So irrespective of where you deposit, either in the US or India, the interest rates that you get would more or less be similar. Joint account, yes, you can have with a local Indian resident on an either or survivor basis. Again, Bangladeshis and Pakistanis need approvals from RBI for opening accounts. Okay, so quickly, if we can go through what are the permitted credits in Nres and Fcnr accounts, because both more or less both of them are similar. Anything that you can send through your foreign banking channels, yes. If someone comes from abroad, who can go to a bank and give the foreign exchange notes and get them credited to their accounts. You can transfer from other accounts, similar accounts like NRE, FCNR accounts, and also you can transfer from an FCNR to NRE and NRE to FCNR also, no issues there. Interest that you accrue on this deposit can also be in these accounts, can also be credited back into these accounts. And sometimes you, because these are people who have been in India, they normally get some rent if they have property or they have invested something in India, they get a dividend or interest or even pension for that matter, that can also be credited. Though it's a rupee credit, it can be credited. Any sales that you do of investments can also be credited into these accounts. But one thing you have to understand is those investments have to be made only through NRE or FCNR accounts. So when you are making the investment, if you have made through NRE and FCNR account only, after selling that investment, you can actually credit this account. Otherwise, it will have to go to a Indian NRO account, not an NRE account. Okay, and any refund of share application money or anything that debenture subscriptions, any other things which are again made through NRE or FCNR account. So one thing we'll have to see is anything that you are selling in India, if you have to deposit into an NRE account or an FCNR account, you have to make sure that at the time of purchase, that amount, that the purchase amount was funded only through NRE or FCNR account. Otherwise, it cannot be done. You will have to only credit it to an NRO account, not NRE or FCNR account. Next slide, please. Again, permitted debits, what all you can make payments out of these accounts. Any local payments you can do. You can make remittances outside India. You can transfer between the accounts. You can invest in the shares or securities of an Indian company, and any movable property that is permitted, you can buy. Because why I put a small asterisk there, because Nris and Pios cannot actually buy agricultural land and plantation or a farm house in India. So beyond that, any other property like houses and all, you can still buy and invest through NRE accounts. Okay, there are certain conditions attached to these accounts. The first thing is when you have become a resident, so you come back from, let's say, US. The moment you come back, within a period of, actually RBI has not specified the period, but ideally it would be like 30 days to 90 days, 1 month to 3 months, you will have to convert the NRE account into an RO account, or sorry, a resident foreign currency account, or actually a rupee account. So there's no, you cannot actually keep it as an NRE account because you are no longer a non-resident. You have come back, and remember the definition: if someone is coming permanently to India, they are not a non-resident. Right from the day they land, they have become Indian residents. So Indian residents are not allowed to have non-resident external accounts. So you will have to approach your bank and say, please convert this into either a resident foreign currency account or a normal rupee account. Time limit of 3 months has not been prescribed, though people actually say it is prescribed. But if you see anywhere in the RBI's circulars and all, that has not been prescribed. It can be any time limit, but we have not actually seen banks acting stringently on this. They are also relaxed. Okay, someone who holds the power of attorney in India from a foreign NRI can actually operate this bank account. One last thing you will have to also remember when operating these accounts is there should be no gifts that are to be made to resident individuals or transferred to another NRO account by the POA holder. The non-resident can do, but the POA holder should not be doing such transactions. Basically, the POA holder should only act based on the instructions of the non-resident account. Next slide, please. Okay, the last one is in an NRO account. Almost everything that you can actually have a credit on the NRE, you can put in NRO account. The only other thing is whatever, if you have actually, but anything that you have invested through NRE account, you can actually get that credit back into NRO accounts also. So the converse is not true. If you have now invested from NRO account, repatriation cannot be done through NRE. But if you have invested through NRE, the money can be sent into NRO also. Okay, and permitted debits, any rupee payments that you want to make, and also remittances. If you want to make remittances outside India in NRE and Fcnr, you don't have a limit, but in NRO accounts, a maximum of 1 million USD cap has been provided. This is basically how RBI has actually classified. If you see, the majority of the funds of the close to $140 billion that you have, it's kind of, if you were to assume about $600 billion being the Indian foreign currency reserves, 601 to be precise, kind of 25% or 23% of that, you actually find this being foreign currency deposits. Totaling here, now basically they can go at any point in time. You can convert these deposits and take it out. So, but the most popular one is NRE because it doesn't have any restrictions to take out. So out of 140, you have $100 billion being in NRE accounts, and NRO is about 20 and roughly about equivalent in Fcnr. Next. I'll just quickly go through this. It looks a little bit complicated for everyone. It's a special non-resident rupee account is something that a person, an NRE, can open in India if they are doing some kind of a business. So it's not actually something that they do through an entity, because if you are incorporating a subsidiary or a partnership firm and all, you would anyway have an account for that thing. But if you are directly doing business without any structure in India, that is where the special non-resident rupee account comes into play. It is only for specific business purposes, because NRE and Fcnr don't permit business transactions. It's a current account. You would not have any interest accruing on this account. And because this is something which came in foreign currency, the money can be repatriated completely out of India without any restrictions there. Maximum tenure has been specified by RBI is 7 years. Anything beyond that, you will have to approach RBI for extension. So if you see one difference between NRE and FCNR versus this account is those two other accounts don't have a time frame. But when you come to SNRR account, there is a 7 years of time frame. Beyond that, if you still want to continue business, people can approach RBI and take permission to extend. Next. Okay, resident bank account is basically NRIs can also open a resident bank account along with the NRIs relatives. There are no restrictions on that. It's just a normal rupee account. You can so then we can just pass it on. You can actually have a resident having a joint account with the non-resident, but the moment the resident actually passes away, that and non-resident becomes the sole holder of this particular account, it has to be converted into an NRO. There are no further restrictions on these accounts. Okay, so that is basically how we look at it. The bank accounts people can open non-residents in India and how funds can come. So basically NRE and FCNR, you get it at a very high level. You can actually say that you can input any amount, you can fund any amount into the account, and you can actually take out any amount without any restrictions. While it comes to NRO, the restrictions are there. In fact, you can actually move only $1 million out in a year. Okay, quickly going through, there are certain, if you see RBI, how FEMA operates is basically the act is there, the 99 Act, then you have FEMA rules. Then at time to time, RBI issues notifications. Then after that, they started this master directions, which was very, very important thing that they have done from 2016 onwards, because they have issued all these guidance, notifications, APDIRs, particularly more like, the circulars and all. So what they did is from 2016 onwards, they started compiling everything and putting it in one place. So if you have to go for any particular transaction, you can go to that master direction and it will be up to date. So you don't need to actually go for 10 different items of guidance. At one single place, you will have everything. Press notes, if you see, is issued not by RBI, but it is issued by DIPPT. Those are also, this was earlier your, DIPP and Ministry of Commerce on how FDI is permitted into India. So though it is not issued by RBI, it also falls under FEMA ambit, and also RBI issues FAQs. Notifications, if you see RBI's notification, the first one was, FEMA, we call it FEMA 21R. That used to be the one thing that people have to, go for, and when they had to acquire immovable property in India. Anything to do with the immovable property, you had to go through the 21R. But after NDI regulations have come in 2019, that was subsumed. So 21R is no longer applicable. 5R deposit regulations still there. 395, 396 NDI and debt instrument regulations. They currently form the heart of what we can look at go forward. Master directions, again, if you see 6, 7, 13, 15, almost all these things, and particularly 15 direct investment by residents, and 13 or even 7 for that matter, LRS. These are, even if you don't remember any of the other regulations, these are the ones that you may want to keep in mind, so that it makes, for at least for a practicing chartered accountant, when you are looking at capital account transactions, I would suggest that these notifications and the master directions, if you take care of, almost I would say 90% of your work is done, because everything would be there here. Other guidance, FAQs, RBI updates from time to time. Okay, so when we come to in 2019, let me take a step back. There were RBI actually, or the government of India actually issued new guidance. They split up the investment into debt and non-debt component. Debt, they said RBI will have to regulate, and RBI came with regulation 396. And then the non-debt part, particularly the equity, every other thing excluding debt, every other investment firm will be governed by the central government, which is basically the Ministry of Finance. This is under your Regulation 395. So this actually covers. So basically, into 2019, the split happened, and if go forward, any regulation change would come from the Ministry of Finance on the non-debt portion. Debt, particularly on the ECB and all, RBI will take care of that. After 2019, very few amendments have taken place in these regulations. Particularly, sectoral caps have been changed. The very few sectors still have caps, but even those sectoral caps have changed in 2010 and 11. And in 2010, particularly when COVID has come in, and then you had particularly China, the market cap of a lot of Indian companies falling. Chinese investors have been looking to acquire Indian companies at very good rates, because the prices were plummeting like anything. So RBI came out and said to stop at least the Chinese investors from investing and controlling Indian companies. They said, any company which is incorporated in a country which has the land border with India, they cannot go through automatic route on share transfers. They will have to approach RBI for approval, and RBI will not give that. Next slide, please. Hello. Okay. Now, if you see what are the permitted investments of NRI and Pios, you can almost see that everything is permitted for them. You can buy residential property, commercial property. You can subscribe to the equity capital of Indian companies, capital contribution to LLPs also. Okay, you can become a partner in an LLP. The only restriction is that, remember, if you have to have one resident partner in case of an LLP, as per the LLP Act. So there cannot be two NRIs who actually form an LLP without a local partner. Otherwise, if one of your partners is a resident Indian, you have, and that too, someone who is more than 182 days, you can have an LLP in India. Stock market investments, yes, you can invest in Indian stock markets. Mutual funds, you can invest in. Particularly all equity mutual funds and also debt mutual mix hybrid funds that you would call, with at least 50% or more of equity exposure, you can invest in. Convertible notes of Indian startup companies. This is a very good initiative that RBI has taken, because earlier, if you were to see, everything was ECB, and ECB norms are not clear. It's not that they are not clear. ECB norms are not easy for every company to follow, and it's like painful and all. So RBI has allowed startup companies, as a part of Digital India campaign and Startup India campaign, they have allowed startup companies to issue convertible notes, and those convertible notes can be subscribed to by non-residents. When I say non-resident, you can take PIO also into consideration. So any non-resident can invest in convertible notes of Indian startup companies. There has been a change. I think in 2021, there has been a change where earlier they permitted the tenure of the notes at 5 years. Now this can be extended up to 10 years also. So startup who is actually formed can issue convertible notes to NRIs up to 10 years. And any good startup would be at a decent place after 10 years. If it is not, it may not even exist. Non-convertible debentures, yes, you can subscribe to NCDs as well. Alternative investment funds, these are funds which actually invest in a whole lot of, if you see AIF's SEBI classifies as type 1, type 2, type 3, right? So any of these types you can invest in. Okay, and NPS also you can continue NPS if you have subscribed to it when you were in India. And FDs and term deposits with banks, obviously that can always be done. Those are So any normal transactions like in mobile property, you can give loans to resident Indians. You can borrow also from resident Indians. You can give guarantees on behalf of them. You can give gifts to your relatives in India, and even in your relatives in India can give gifts to NRIs. You can do remittances to your family members. And any assets that you have in India, after your sale or disposal, you can actually take that money out of India. There's no bar. Again, you will have to see the kind of restrictions that are there, like 1 million on the NR account. Beyond that, you can, if you have sold a property which is say 3 million, 4 million kind of it, you will have to wait till every year you can only repatriate only some part of it. Okay. When it comes to immobile property, actually a lot of NRIs would be interested in buying immobile property in India. The first thing, if you see, is you can purchase residential or commercial property. There's no bar, because the RBI mentions as immobile property. They never said anything on resident. Should it be residential? Should it be commercial? So I know you can actually buy any property in India, and any Indian resident can also gift you this particular property. Okay, so you being an NRI, any Indian resident can also give a gift to an NRI or a PIO to any property in India, except for, again, when we are talking about property, we consider it only as property which is not agricultural land, plantation, and farmhouse. Beyond that, there's no restrictions. You can also get it through inheritance. Let us say someone's parents were in India and the person is an NRI at this point in time. Okay, so what the person can do is through inheritance, they can get this thing. But again, if they want, they can retain it in India, even if it is a farmland and all, because they have not acquired this, right? NRI cannot acquire the plantation or agricultural land in India. But at some point in time, if they are able to, they get this through inheritance, right? The act does not prohibit them to hold. From holding it, they need not dispose it off. The only thing is, when they are disposing it off, they should sell it only to an Indian resident. That's the only thing. So you can get these things through inheritance, but and you can even keep it even if you are an NRI, even if it's an agricultural land. But if you want to dispose of the land, you can only sell it to an Indian resident. NRIs can also avail home loans from Indian banks. So if you are buying a home in India, banks are there to give you loans. The repayment can be made either from any of these accounts. Fcnr is not mentioned because it's a deposit account. So either your NRE or another account can be made, the payments can be made. Again, the one small difference here is this is applicable only to an NRI and not an OCI or a PIO for that matter, because the Act wanted only Indian citizens to get that benefit. Okay, and acquisition can be done from any inward funds. Okay, there's no limit on the number of properties what you can actually. It basically depends upon how much funds you have. You can actually buy any number of properties, and NRI can continue owning a property. That was what. Again, see, if at all you were a resident and you bought agricultural land or a plantation, and later on you became an NRI, the Act does not actually prohibit you from holding agricultural land just because you are a non-resident. But again, when you are disposing it off, if you are doing that, you will have to sell it only to an Indian resident. Okay, in NRI, OCI, NRI or PIO cannot purchase inheritance. So one thing that they have actually given a carve out is NRI or PIO cannot purchase an inherited property from a PIO. I don't know why this restriction was made, but because this is there in the statute, we will have to follow it. Next slide. Okay, so again, as we were speaking, agricultural land or plantation is something which India does not want non-residents to control it. They all want only residents to control agricultural land because it's something that concerns the food security of the country. So NRIs or PIOs are not eligible to buy this thing. If anyone wants to buy, they will have to get RBI's approval. And I'm not sure if anyone has even got RBI's approval to purchase this agricultural land. Property can be inherited, as we have seen earlier, and you can retain the property. Gift of such property to NRI or PIO is also not permissible. So you cannot gift an agricultural land. An Indian resident cannot give an agricultural land to NRI or PIO because they cannot buy it. You cannot say, okay, because they cannot buy it, I'm giving a gift to them. That also is not permissible. So only way for an NRI or PIO to acquire agricultural property is either they acquire it when they were Indian residents, or they get it through inheritance. That is it. And inheritance does not mean they have to be your relatives. Even someone who is your neighbor can give you, write a will in your favor, and you can inherit that. So just don't assume that inheritance means only your family and all. Anyone who in their will actually writes that mentions your name, or rather the NRI's name, and says this property will have to go to the NRI, they can actually get that. Next slide. Okay, now coming to the taxation part of it, NRI, when they are actually purchasing immobile property in India from a resident, if they are buying it, if a resident buys from a non-resident, if NRI is buying from a resident, normally the normal 1% TDS that you make on 194IA, that is the normal section that you have. But when you are buying it from a non-resident is where the complexity comes. So you will have to see whether it's a long-term capital gain or a short-term capital gain, and you will have to deduct tax accordingly, and the tax has to be with the surcharge and all. So you will have to. So if there is an NRI who is buying from a resident any property, mobile property, it is fine. There's hardly any compliance requirements. But when you are actually a non-resident buying from another non-resident, or even for that matter an Indian resident buying from a non-resident, you will have to ensure that TDS under 195 provisions, section 195 provisions are taken care of, classify whether it's long-term, short-term, okay, and ensure that the TDS is deducted. Even if you are giving an advance, ensure TDS is deducted. Buyer will have to apply PAN, even though they don't even though they don't have any other transactions, they will have to apply for the TAN. And also, you should not bifurcate that this is the gain and this is something which is the principal amount. That is something that is not for the buyer to do, it is for the department to do. So you will have to deduct the tax on the whole amount. If you have any doubt, you will have to approach the department, and then they will actually issue a certificate on how much tax has to be deducted. But that is not in our hands to actually specify this is the gain and I'm deducting tax on that. But again, it's very, very critical to identify whether a person is a resident or non-resident. And when you are applying for a lower tax deduction certificate and all, the non-resident can actually take the treaty benefit, whichever country they are in. If that country has a treaty with India, yeah, they can go ahead and opt for that treaty benefit. Okay, again, immobile property on the taxation will continue. Because the immobile property is in India, capital gains are taxable in India. They are at the same rates that are applicable to your resident. Again, even non-residents can also claim deductions under sections 54, 54EC, 54F. So there's nothing that prohibits them from claiming deductions. Whatever are the permissible investments, they can actually do that. Investments, they can actually do that investments. And if at all TDS has been deducted in excess, they can actually file a return in India and actually claim the excess tax which is not payable by them. So they will also get that. Also, if you see, if you are a resident, say in the US, there are also taxes payable in the US, because US is a country which actually taxes people based on a residency. If you have a if you are a PR in the US or you are a citizen in the US, then your global income is taxable. So for those people, they can claim exemptions based on DTA. And US people will also have to, this is a specific US, only for US residents, they can actually take something called a foreign primary exclusion. See, there is an exclusion of up to $500,000 of sale consideration on which tax is not payable when you actually prove in the US that you have been living in that particular property for more than 2 years in a period of 5 years. Okay, so that is what is called a primary exclusion, and that is only applicable for US. So when you are actually having any client from the US, you may want to actually tell them both the compliances. In India, obviously you'll tell them, but it'll always be a good practice to actually look into the US compliances, and some of them may not be aware. You may want to even tell them that they have certain exclusions in the US on the capital gains tax that they may want to. On repatriation front, you can actually repatriate the sale consideration outside India, because once tax is paid, there's nothing that will stop the amount from leaving India. If you have invested from NRE, then the entire amount can be taken out. There's no restriction there. But if you are actually selling a property that has not been invested through an NRE account, maybe it is invested through an NRO account, or it is an inherited property, then there are certain restrictions that, if you cannot repatriate for more than 2 residential properties, and a minimum holding period of 10 years has to be there since you have purchased and then you have sold and you want to remit. So right from the time of purchase to the time of remittance, if you have not invested through an NRE account, you will have to hold the money for 10 years. This is only to ensure that, that there's no speculation in the market, that money comes in, you invest, or, local money is taken by NRI, they invest, they want to repatriate, they sell, they want to repatriate outside India. So that is what a safeguard has been provided by the RBI. Repatriation, again, $1 million per financial year NRO accounts. You can repatriate outside India. The bank would obviously ask you for 15 CACB to be submitted and A2 for remittance. Next slide. Okay, it's a brief table. Who all can sell to whom? Maybe you can actually look into this slide later. But immobile property, an NRI can sell to anyone. He can sell to an Indian resident. They can also sell to an NRI. He can sell to a PIO. But a PIO has to sell immobile property only to an Indian resident. So that is one thing. Agricultural land or plantation, NRI has to actually sell only to an Indian resident. It should not be anyone else. Gifts also, NRI has to can give to anyone. PIO can give to anyone. But again, gift of agricultural land, again, when you want to give, it should only be an Indian resident. But a PIO can do only to an Indian resident and should be an Indian citizen. Okay, a non-Indian citizen who's still an Indian resident cannot take a gift from even a PIO, and the PIO cannot even sell to them. The next slide. Okay, on the stock market, again, many NRIs want to invest in stock markets in India. NRIs can actually invest in shares of listed companies through PIS. There is a portfolio investment service, I believe, PIS, that banks do offer. You can actually get your money through an NRE account, then you can repatriate. An NRO account, you cannot repatriate. Again, that limit is there. So what you can do is the PIS account will be opened by the bank. Okay, you send the money from your NRE account into the PIS account. The PIS account will be linked to a demat account. Okay, and the demat account is where your trades takes place. and your profit or loss first comes from your demat account to your PIS account. The PIS account, the bank ensures that they are actually deducting TDS on the gains you have made, and whatever is the balance there, you can actually transfer it back to your NRO and NRE accounts. So this is something which is you can, any bank offers. Normally people go with major banks like ICICI, Axis or SBI and all, but a lot of banks do offer this PIS services for NRE clients. You link it to these accounts and you can trade like anything. Only thing is they can only buy shares, but they cannot actually trade in derivatives. So you cannot do intraday trading kind of it, and intraday derivatives trade you cannot do, but you can still buy derivatives, options, forwards, futures, and all. You can still buy and sell them, but not on an intraday basis. That is not permitted because they just want to eliminate the speculation in the Indian markets. Again, India intraday trading is not permitted for NRI. You cannot. You will only have to sell these stocks in on the stock market. You cannot actually have an agreement with someone else and say, I am transferring these shares to you. You give me the money. That's not permitted because everywhere the RBI and the income tax department wanted to get the money, calculate the gains, and then deduct TDS, and only then money gets repatriated in outside India. Yes, NRIs can apply for IPOs or FPOs on issue of shares, but only thing is you will when they are actually people are applying, they will have to see, because not every company may be interested. Small issues, say 500 crores, 300 crores, they may not even be interested in allowing NRIs to invest because they unnecessarily have to do all those compliances with the RBI on issue of shares and all. So they may say only residents can apply. But if there are large issues, like we have seen LIC issue, we have earlier seen delivery and all, which are big issues, they allowed NRIs to actually apply on the IPOs. You can also receive shares on inheritance, and you can also invest in mutual funds. Some requirements are there for US and Canada citizens, but again, that's out of our bracket right now. Others, you can still invest in commodity markets. Also, you can invest. Again, that is there. You have Indian commodity exchanges, you can trade on them, gold, everything. You can invest in mutual funds, either open-ended funds, closed-ended funds. Every single fund you can actually invest. You can invest in government securities, treasury bills, ETFs. So there is nothing on the financial market side that they said that is excluded for NRIs. Every single investment avenue is available, but it is not the same that you would expect how an Indian resident would operate. There are some guidelines on how you will have to operate. One thing you will have to see is that the currency trading on INR and whatever is the foreign currency is not permitted for NRIs. Indian residents can still do that, but again, it's not on the apps that people talk about. The RBI has said you will have to do it only on the recognized exchanges. So Indian residents can do it on recognized currency exchanges. It can be NSE, it can be BSE, it can be commodities exchange and all. But non-residents cannot do currency trading. It is possible through IFSC. We will see that later. Taxation, if you see long-term capital gains of 10%, particularly when we are looking at shares, right? Long-term capital gains are taxable at 10%, short-term at 15%. When you are looking at a mutual fund, and the criteria is 12 months. Debt funds, similar to residents, 36 months for long-term, short-term classification, 20% on long-term, and slab rates for short-term. And dividend payouts, again, the same thing like how we see for residents, the 10% is the tax. If you see again on the listed shares, If you are actually selling listed shares, the short-term capital gains are at 15%, and the holding period is the same, like 12 months, which we look at in the normal income tax, right? 3 years for debt holding debt mutual funds. Long-term capital gains at 10% for equity, 20% for debt funds. That is the same thing that we normally do with indexation and without indexation also apply to them. TDS is to be deducted at applicable rates, and the bank will ensure that. So here what happens is when you are investing through a PMS scheme, right? And you have a demat account attached to the PMS, before actually crediting the NRO or NRE account, the bank will actually deduct the TDS based on the transactions, and then it will remit the money into those accounts. Again, the higher rate of TDS provisions are not applicable. Though 206A is applicable only for mutual fund redemptions. If you actually see that there are a list of documents that are specified under Rule 37 BC on what all documents constitute, because if non-resident does not have a PAN, right, what all documents they can actually provide, that Rule 37 BC documents, if you can provide, yes, it is treated, you need not actually suffer the 206A higher tax deductions. Yeah, next. Okay, unlisted companies, again, 24 months, 20% applicable tax rates if you are a short-term capital gain. Okay, now if you have a US client, this is one thing you may want to actually tell them. US capital gains are around 15 to 20% on gain of shares. I think the 15% applies if you have more than some 40,000 or something of capital gains, and anything beyond that, you have a progressive taxation there. 1 year holding period is considered as long-term, short-term locally, because see, again, when you are talking about a US resident, you will have to also bear in mind that you will have to deal with taxation on both the sides. If you can provide the tax positions on both the sides, normally the client will be very interested with you. So then it's a good practice that you also see the US regulations. Normally US regulations, irrespective of what India says, US actually has a 1 year holding period between long-term and short-term. And US clients also need to consider there's something called a subpart F in controlled foreign company regulations, where even income of a company in which if they hold more than 10% individually or 50% all US residents in any company around the world, if it actually has satisfies some conditions, then even if you don't declare dividend, they will have to pay tax on that income in the US. So you may want to actually consider that angle also when you are advising your client on the investments that are made in India. Yes, please. Okay, so investments in India, what all they can do in automatic route. See, every investment of an NRI and PIO is in an automatic route. There's nothing that you need to actually take permission for. Again, when we are looking at automatic route, again, Bangladesh, Pakistan are excluded, but everyone else can actually invest in shares, CCDs. You can invest in the partnership firm, a normal partnership firm. You can invest in an LLP. You can invest in convertible notes. Okay, and you can actually invest in mutual funds, REITs, alternate investments funds. Everything that you can invest in, there's no prohibition. So NRIs and PIOs, if someone asks you about what investment they can do in India, you can actually tell them you can do every single thing that a resident does in India. One single thing you can tell them. And RBI has been very, very free and very accommodative in the kind of investment that comes in, particularly when you are bringing it in US dollars in foreign exchange. There is no restriction on taking the money out of India. So if you see, normally we call India as not a country that is fully convertible on a capital account. We are nearly there, because even when money is coming in, the RBI does not have a problem in sending money out, whatever has come in. So if we are nearly there when it comes to a capital account convertibility. It is wrong to say it is not convertible. We are nearly there when we on capital account convertibility. Yeah, next slide. Okay, this is one thing interesting. If you see, Nres can hold 100% shares in an Indian company. There are no sectoral caps. Sectoral caps are there in some sectors that where very few sectors are there, like mining or defense or telecommunications, insurance, banking. But predominantly, you will not find sectors where there is which are having sectoral caps. Even in those sectors, the cap is really high, so it's not a problem. Investment in LLPs is permitted, as we have seen. NRIs can be directors of an Indian company. There's nothing that prohibits them from being, because you will always have at least one director who is resident in India, so not a problem. Okay, you can acquire bonus shares and right shares. Particularly right shares, you will have to take in mind that if someone is actually not subscribed, an Indian resident is not subscribing to right shares, and they are actually sending those shares for subscription to an NRI, you will have to ensure that those right shares are actually as per the prescribed valuation rules. There is no permission that is required to transfer shares by an NRI, and investment gains can be repatriated. There's no issue around that. Okay. Filings by an Indian companies, because once NRIs invest into India, there are a lot of filings that have to be done by Indian companies. First thing is FCGPR, which I think everyone knows. It has to be filed within 30 days from the issue of shares. Normally, when a share, first thing is share application, money comes in, you file the ARF, and then you will have to issue shares. RBI says 180 days, companies Act says 60 days. So obviously 60 days being the lower limit, you would issue your shares. And then after that, within 30 days, you would file your FCGPR. FLA you will have to file on the 15th of July. Normally, RBI has been giving relaxation last 2 years because of COVID, but for FLA has to be filed every year. FCTRS, wherever investment has been made on repatriable basis, and there is a transfer of shares, right? So you will have to file FCTRS. The onus is on the resident transferor who is doing that transfer. Okay, LLP 1 is a form. The moment you get a contribution, just like how you file an ARF, right? In case of company, you will file LLP 1 in case of an LLP, and on the divestment or transfer, like an FCTRS, you would file LLP 2. CN is filed by startups, the way which have issued the convertible notes. Again, when we say startup, it is not a definition of a startup that you would say that this is a startup I have formed it recently. No, it is something which has to be done through your Department for Industry Promotion of Industry, DPIT it is called, DPIIT rather. Earlier, it was called Department of Industrial Planning and Promotion, but now it has got merged with another department. This rolls up into Ministry of Commerce. So you will have to first be a registered startup, and only a registered startup will be able to issue convertible notes. So not everyone who starts a company becomes a startup. Okay, and NRI has to ensure that the company does the requisite filings, because I have actually seen cases where the NRI gets held up when they want to transfer the shares, because the company has not done the filings, either FCGPR or FLS, and also they face some hurdles, and that is not warranted. So better the NRI should also ensure, because when they are investing, normally they would invest in private limited companies where they know the promoters and all. They should ensure that the company is compliant when it is doing this filings. And investments, so if you see investment from NRO accounts are considered as domestic investments because they are not repatriable. There are no filings that are needed. So every single thing FCGPR or FCTRS is needed only on on repatriable investments and not on non-repatriable investments. Okay, loans by NRIs. NRIs can actually give loans to individuals and companies. If an NRI has to give to a resident individual, it has to be in INR. It should not be on a repatriable basis. It has to be only on non-repatriation basis. And the maximum, tenure can be 3 years. There is an interest rate cap which RBI keeps changing. So, at a high level, you can say NRI can actually give a loan to a resident individual in INR, and they cannot actually take money out, whatever is being repaid. Now, NRIs can give loans even to resident companies. The company can issue an NCD. It can be done on repatriation or non-repatriation basis, no issues. Like earlier, we had only on non-repatriation basis, right? Here it is a repatriation basis or non-repatriation, both is permitted. The minimum tenure is 3 years. This you will even find in public deposits clause when you come, I think later in the slides, you will see that there is an interest rate cap. End-use restrictions are also there. So if a company is borrowing some money for something from an NRI, it has to ensure that the funds are put to use. You cannot borrow money from an NRI and just pass it on to a subsidiary company or use it for onward lending and all. That is not permitted. And again, you cannot lend to companies. NRI loans should not be taken by companies which are into plantation and farming and all. You cannot do that. Very, very minor things, but you will have to take note of that. NRIs can also deposit basically your public deposits, right? So any company in India which can issue public deposits as permitted by your Companies Act, they can also raise money from NRIs. They can accept it through NRE or FCNR accounts. So end-use restriction is applicable. Obviously, the maturity period is 3 years, like how we have seen on how an NRI can give a loan to a company, right? Similar thing on deposits to public deposits. Okay, and then it can be repatriated after the loan is repaid by the company. The NRI can actually repatriate this amount back to the home country. Again, the one thing is, there is a small exclusion where deposits can be taken by firms, LLPs, and even proprietary concerns. But again, those have to be only on non-repatriable basis, because this is more like, lending to an individual and not lending to any other entity. So what RBI says is you can still borrow from a non-resident, even if you are a partnership firm, you are an LLP, you go ahead and borrow, but you cannot actually do it on a repatriable basis. Please do it only on a non-repatriable basis. If you want to do it on a repatriable basis, again, this is applicable only for LLPs. They will have to abide by the ECB guidelines. Because from 2019 onwards, when Regulation 396 came in, right, and the debt rules have been given, RBI has permitted even LLPs to borrow ECBs. Earlier, ECB was not permitted for LLPs. From then they permitted. So if you are wanting to borrow money on repatriable basis, you can still do it, but you will have to go on the ECB route and not an NRI deposit. Let's do it. Yes. Okay, so private trust, NRIs and private trust, we can actually see this thing. It's a little, trust thing is a little complex, but I'll try to explain it, how it works. Okay, so if you are having a trust in which the settler is an Indian resident or a non-resident, so wherever you have either a settler being a non-resident or the beneficiary being a non-resident, okay, then you fall under FEMA ambit, because it is either one of them is a non-resident. So if you have a settler is an resident and the beneficiary is a resident, no problem at all. FEMA is not even applicable. But the moment one of these parties is a non-resident, FEMA comes into play. Okay, so in case of a specific trust where the non-resident is a beneficiary, yes, you will need an RBI approval. I believe you know about the specific trust, right? The share of the beneficiaries in a specific trust is specified. Like, they will say, like, if the trust gets 100 rupees, 30 goes to Mr. A, 30 goes to Mr. B, 40 goes to C. So this is a specific trust. So there is no discretion on the trustees' part to actually allocate the shares. It will be given in the trustee. The trustees will only have to follow that. So the moment it's a specific trust, and let us say one Mr. A is a non-resident and is a beneficiary of an Indian trust, RBI's approval is needed. So that is one thing you will have to take care. So even NRI can actually become a beneficiary of an Indian trust, but you can you'll have to take RBI approval for that. If it is a foreign trust, say there is an Indian, but the trustee or the settler is a foreigner. If it's a specific trust, then you actually comply with the sections 4 and 8 of FEMA, which actually require you to go and get an approval and all, where it's a discretionary trust. So in a discretionary trust, the trustee has the final say. So we had ABC 30, 30, 40, right? That was in a specific trust. In a discretionary trust, what happens is the trustee can give the entire 100% to A, or say 50 to A, 50 to B, and they'll say, I will not give anything to C, or they'll say 10 I will give to A, 20 I will. So this is completely at their discretion. In case of a discretionary trust, the company has, the trustee has the ultimate authority. They'll say, I will not even give anything to A, B, and C also. So where the trust is a discretionary trust, RBI's approval is needed to be in compliance with the FEMA. You will have to require approval, specific approval from RBI. Okay, in case of a succession. Now, let us say there is a family in which, on the death of the person, the property has gone to a trust. Okay, now one of the beneficiaries of that family trust is outside India. Will you require RBI approval? I think it may not require an RBI approval, because that is done, the process gets covered by the Succession Act and not FEMA. So where there is a family trust in which an NRA is a beneficiary, and upon the demise of the owner or the head of the family moves into the property moves into a trust property, and the NRA becomes a beneficiary of the trust property or the trust, you will not require RBI's approval for that, because that operates through succession, not as a part of a FEMA capital account transaction. Normally, family trusts are created when you have a huge net worth which you leave your estate to your children and beneficiary again may liquidate his share in the trust and repatriate the money out of India, and that is restricted to about 1 million per annum. So non-resident can also be a trustee of an Indian trust. Yes, there's no specific restriction on the trust as per the Indian Trusts Act from a non-resident being a trustee. But actually there are two sections if you go through the Trusts Act which actually disqualifies the non-resident when they are absent from India for 6 months. So you cannot expect the trustee to come back to India for every 6 months. So though it is not technically prohibited, it is not practically possible to be a trustee in India of a trust by a non-resident. Okay, and also there's a section 60 which says trustee should be a proper person, and it also says a person who is domiciled abroad is not a proper person. So basically, technically, there's no prohibition, but practically, it's better you don't have non-resident trustees on Indian trusts. Yes, please. Okay, in startup investments, as we have seen there, right? NRIs can invest in startups. They can do equity shares, that they can do CCPS, CCDs, convertible everything is permitted for them. Okay, and what they can do is, these startups can also go on the ECB route and borrow 3 million per financial year. So this is something which they have, RBI has given a leeway to startups for as a part of the Startup India and Digital India program. So anyone, an NRI can invest, and even a venture capital fund which is floated by NRI can also invest in these things, startups. Yes, please. Next slide. Okay, so we come to investments outbound. Basically, I'll try to wrap it up in the interest of time in the next 10 minutes. I'll try to wrap it up and we, move on to the Q&As. I'm sorry, there was a small delay in the first part, which is actually making this run. So permitted capital account transactions for Indian residents, if you see, they can acquire residential and commercial property abroad. There's no restriction on that. They can even acquire agricultural land outside India, obviously. So RBI said, Indians, NRIs cannot, non-residents cannot acquire agricultural land in India, but Indian residents can in turn acquire agricultural land outside India. Only thing is there are a lot of other countries also which have similar restrictions, and even on agricultural land and also on residential properties. So as long as those countries permit, we don't have a problem on a FEMA perspective from either buying residential property, commercial property, or agricultural land. So any property you can buy outside India, being a resident in India. Shares of overseas companies, yes, you can actually open a demat account outside India, and you can invest in whatever you want, Amazon, Google, Facebook, everything you can invest you can invest in the shares. Qualification shares for being a director, obviously, yes, when you can buy those shares. If you have received any remuneration for your services rendered, you can hold those shares. But one thing you may want to consider is, because RBI, as per FEMA, anything that you have received being a resident has to be actually surrendered within a prescribed time, normally 90 to 180 days. Normally, they did not specify the remuneration received in shares form, so it should be allowed, but there is no specific guidance here. Bonus right shares, if they are given, you can hold them on whatever shares that you have purchased. You can buy mutual funds, ETFs outside India. You can even set up your own wholly owned subsidiary outside India. There are certain conditions, but you can actually take money outside India and form a wholly owned subsidiary. So you can invest 100% of your, you can form a company outside India, let us say in Singapore, and you can invest 100% of the share capital and still remain in India. And that 100% wholly owned company becomes yours. So that is permitted. You can give interest-free loans to NRI relatives in INR. Again, if you have NRI relatives and you want to give them a loan, you can give them in INR, and that loan has to be given only into their NRO account. NRE will not even accept that thing. And when you talk about relatives, please note that this is a very restricted definition which RBI uses, or rather in FEMA. It is aligned to your 2 subsection 77 of the Companies Act, where you have very, very small set of people. You have mother, father, brother, sister, son, daughter, and maybe stepfather, stepmother, kind of it. Beyond that, it's a very, very narrow definition. So if there are anyone in this NRIs, you can actually give loans to them. You can give donate gifts to them, or you can even get gifts and donations from them. And any resident can even bill property on their death to people like NRI who is outside India as well. So those are the permitted capital account transactions for Indian residents. Now, the next thing, if you see, is LRS. This is the heart of whatever an Indian resident can do. This, is the heart of it. So it was first introduced in 2004 for $25,000. So LRS is more like an entitlement where you can actually go, given INR, buy US dollars and do whatever you want with those in US dollars. There are very, very few restrictions, like you cannot do gambling and all, but otherwise, there are no restrictions on what you can do with your LRS money. it is available to resident individuals. The cap applicable per resident per financial year. So from April of last year till March of this year, you can draw $250,000. And again in April this year, you can start using your $250,000. So you can still do a 250,000 USD in March. You can do a 250,000 in April. So in $500,000, you can actually send out in 2 months because they straddle across 2 financial years. So the cap is at 250,000 is per financial year. But you can still borrow money from banks and all for doing this. There is no particular restriction as such, but normally what RBI does not like this particular thing, though there is no particular circular. Normally what happens is in case of student loans and all, people actually, because that is also through LRS, right? People mortgage their property and all for their children, and then they use their LRS limit, and then they convert. So that is there. So the $250,000 limit you have, you can actually spend on anything. Be it a current account transaction, be it a capital account transaction. There's nothing that stops you from doing. You can spend it whatever. Even the formation of a company, I said, right, in the earlier slide, 100% wholly owned subsidiary you can form outside India. As long as it is within your LRS limit, you can go ahead. One specific restriction that is there is you cannot use between 2 residents. So I am there, I have a limit. So, and someone is there, they have a limit. So I cannot actually send money from my account. I draw 250,000 USD, send it outside India, and I cannot deposit in another resident's bank account outside India. So they want to, this is how, the money laundering part starts. So they wanted to avoid this thing. Clubbing of limits is not permissible. I cannot say, we are all one family. So, we will pull up all our, we have 4 people in our family. It becomes 1 million, I will send outside India. No, that is not permitted. In only one case that is permitted. If you are buying an immobile property outside India, you can still club all your 4 people's eligibility and say you can make it 1 million. But again, in that case, the property has to be registered in the name of all the 4 people. So you being an Indian resident, you can still maintain and hold a foreign currency bank account outside India. Income on LRS, let's say you buy stocks or you buy bonds, you get interest or you get dividends. That is not required to be repatriated into India. But the only condition is if you dispose of the main investment, if you dispose of the stocks, then you will have to bring back that money within 6 months. That is there. If you this thing, if you go back, if you see from 2014 onwards, 1 billion of remittance on LRS has now become in FY22 $20 billion. So in the first slide, we have seen 83 billion of inward remittances. Now close to 25% of it is going out. And trust me, RBI has been very, very liberal when it comes to LRS, because $250,000 is a very significant amount that you see, particularly when you consider the financial position of the country, right? At $600 billion. At $600 billion of forex reserves, if you are giving 250, China has $3.3 trillion of reserves, and at best they allow $15,000 per person to take out of the country. So imagine the kind of thing, how liberal RBI is. So so RBI is very liberal, even with lesser reserves. You can actually take out significant money out of India. There are there are things which even the Ministry of Finance has actually said that this is kind of encouraging money laundering and all that. But, RBI has not actually stopped. Maybe now that, money is going out of India, forex reserves have gone down from 650 to 600 billion. Maybe there may be a change, but we don't see that happening right now. Yeah. So we have seen what all can be done. I think we can pass through this slide. And what are the major categories how LRS is being spent out of India? Mostly it is spent in, I would say non-capital formation. travel accounting for a major part of it, maintenance studies and all. Very, very small part of it is actually spent on kind of capital formation like investments outside India or deposit, but overwhelming majority, around 85 to 90% of the LRS is going on expenditure category and not an investment category, but still RBI has been accommodative on it. And one other thing, if you see in the main usage categories, there's the last line, healthcare expenses. The overall limit of 250,000 is actually enhanced by RBI in case, if you have to go for a surgery or something outside India, and the estimate that is given by the local hospital is more than $250,000, then yes, RBI will permit you to draw even say $500,000. Yeah, please. This is something which we have discussed. You can form a wholly owned subsidiary and joint venture outside India. The only restrictions are you cannot do banking or real estate business outside through that company. It should be an operating company. It should not be a shell company, because they don't want someone to actually incorporate a company outside India, keep sending money, and the company keeps money there outside India, and then the shares get transferred, and they don't want a legal route to be used as a hawala. So they said, if you are incorporating an entity outside India as a wholly owned subsidiary, it has to be an operating company, and it is also not permitted to invest back into any Indian companies. So you cannot actually form a company outside India and again bring that money into India, like round tripping. That is not permitted. Again, cannot be made in countries which is deemed as non-cooperative, because there are FATF, Financial Action Task Force is there, right? Which actually recently identified even Turkey to be non-cooperative. So you cannot invest in some of these countries which are deemed as non-cooperative. Otherwise, you have to be, as long as you are within LRS, it is permitted. You cannot have subsidiaries for that company. It has to be a standalone company. You file APR, and if you are divesting it, bring back the money within 60 days. Okay, surrender of foreign exchange. I think normally this is something you can go through once you get the slides. Any amount that you draw on LRS, if you're not spending it, there's a time limit of 90 to 180 days, depending upon the category of drawal. You will have to ensure that if you are not spending the amount, you will have to give it back. Only thing is, you can keep $2,000. Beyond that, anything else you will have to give it back. Okay. Taxation, taxation status is again on the when we call Indian resident, right? It's basically a FEMA definition. Okay, the residential status obviously for tax purposes determined by the Income Tax Act. All income tax rates are applicable as they are applicable to a resident individual. Okay, so if you are actually having income outside India, being a resident, your global income is taxable. So even if you have an interest or you have a dividend which is on your LRS investments, even if it is not remitted to India, you will have to pay tax on that. Obviously, you will get credit of the TDS that has been suffered outside India. When you have capital gains, also those capital gains are taxable in India. And when you are making LRS remittances, one thing you will have to see is the 2061G, which actually says, the TCS will have to be collected. Obviously, there are different percentages there when you see. I don't want to go through this, but if you go through 2061G, you will have. Okay, particularly if many people in India are interested in the US also. If you see from a US taxation perspective, mutual funds and ETFs, if they issue a dividend, they deduct a 25% withholding tax credit you can claim in India. If the stocks are there, again, they issue a dividend, 25% withholding tax is deducted. No tax on US share capital gains by shares by now. So when you are investing from India, you are categorized as a non-resident alien. Okay, because one is you are non-resident, and second one is you are investing from outside in US, so you are a non-resident alien. So you will not have capital gains tax, but obviously those capital gains tax you will have to pay in India, being an Indian resident. So that the moment and the holding period, obviously for US purposes is different, Indian purposes is different. US anyway they don't tax, so you will have to consider the Indian classification when you are dealing with even the shares are US shares. You will have to consider the Indian holding periods, and they will be classified as unlisted shares because those shares are not listed in India. Even though they are listed on, say, NASDAQ or NYSE, they are still classified as unlisted shares because they are not listed in India. Derivatives, obviously, yeah, but still there is no tax on non-residents in US derivatives. So LRS actually prohibits Indians from investing and trading in derivatives outside India. So, that is ruled out also for us. Okay, so I think this is the last slide for us. Gift City, if you see, this is formed near Ahmedabad. This is like India wants to mimic the offshore financial center, like on the lines of a Singapore or Hong Kong. So what they did is they actually set up this Gift City, and Indian residents can make LRS investments in the Gift City. So currently, if you see, Gift City is operating, there are few stocks of the US companies trading in Gift City, like Tesla and all. I think 5 they have started, and they will actually go to 50 by the end of the year. So these US stocks you can actually trade on Gift City in India, and you can draw it through LRS. Okay, and any amount you draw, you send it across to Gift City, you can actually get it back. If it is not spent, you will have to come back to India. The tax position, there are no benefits for resident individuals, but for non-residents and resident and not outline residents, any interest that you derive from the IFSC banking units, they accept deposits. That is actually free of tax. And tax, even for non-residents, there is a tax exemption on the trading of non-deliverable forward transactions. Non-deliverable forwards, anyway, Indians cannot invest in them. Only people who don't have access to Indian forex derivatives market can trade on them. Earlier, they used to actually trade in Singapore, Hong Kong, and even New York. But RBI wants them to come closer offshore so that Indian banks can actually have control on this, because the moment you have a non-derivable forward, this is also called an offshore rupee. RBI never had control on the offshore rupee, so the offshore premiums that were there, an INR USD may be trading close to about 20 to 30 paise different from what an offshore rupee was there. And looking at the offshore rupee, the INR used to depreciate because India is a managed market, right? So people used to feel without any influence, this is the actual rate. So RBI wanted to always, it was the major aim of RBI to actually discourage non-deliverable forwards and move them closer to home. And in Gift City, you have Indian banks which are operating in banking units, and they are allowed to deal in India. So at least some part of that non-deliverable forwards and offshore rupee trade has moved onshore into India. Yes. Okay, closing note, what we can do is say FEMA, if you see, is dynamic law. It's not it, and it is an intent-based law. It is not like an income tax act where you read section by section and say, okay, the word is may, it is not should, or it is shall, and it is. So you cannot read and interpret the act and kind of try playing with the words there. It is an intent-based act. The moment the RBI and the government has a certain intent, the intent should be taken into account, and it should not be that because the wording is not there, you cannot say, I have worked around with that wording. Again, extremely fact specific, you will have to understand whenever your client comes to you, you will have to understand all the facts of the transaction in detail before you are proposing some solution, because you cannot take a citation like, an income tax act where something happened in a different case that is applicable in this case. It is not. The other thing you'll have to understand is it's a complex law. Don't believe in everyone. If anyone says, I know this FEMA completely, no one actually knows FEMA completely in and out. So, refer all possible guidance. Don't go by precedents. Take your time in case an NRI comes to you for suggestion. Take your time. Don't rush to solutions. Again, don't rely on banks' advice also, because I have actually seen so many people, employees who are bank employees, okay, who actually are not aware of FEMA regulations. Trust me, don't even believe your banker unless they are very, very senior people in the bank and they are working in specialized forex division of the bank. Please don't take your bank advice also, because in many of these cases I have seen in state-run banks, they are not aware of the regulations of FEMA. Then at best they may actually say, I'll call up my counterpart in Mumbai and find out. Okay, take a conservative position on structures. Don't, Income Tax Act is still fine if you take aggressive positions. It will save you tax, but don't take any aggressive position when it comes to FEMA. Do obviously take a very conservative approach. Think from all sides, because once a transaction and a structure is made on outbound investment, not particularly from an individual perspective, but from a company perspective, if it is not in compliance with FEMA, RBI can, if compounding is possible, they will compound. If compounding is not possible, they will ask you to wind down the structure. They'll ask you to sell your investment, and at that point in time, your entire business may be at stake. So don't take aggressive positions on FEMA. Please take only conservative stance. Don't rely on fintech transactions like crypto and all, saying that, there are some people who may want to actually invest in crypto, Bitcoins, or some other things. And, because you can transfer to any wallet, transfer it to a person outside India, wherever you want. That is not permitted, though RBI has not given any guidance there. RBI is not favorable to crypto. Please don't use any of these fintech companies for transferring money outside India, because even if it is LRS has to go through foreign currency and banking channels. None of these are banking channels. Expert advice, please consult any experts in the FEMA area. Don't do Google for your help. Google is not a repository for FEMA. If you have access, if you're living in any of these metro cities, you can even walk into an RBI's office, and the Foreign Exchange Department of RBI is very helpful. I've visited them a lot of times. They are very, very helpful when it comes to advising people. And if you have a problem, they will also suggest a solution. So if you have issues, please feel free to go and ask RBI for help. In case of, again, non-compliances, wherever possible, go for compounding immediately. Don't wait for RBI to come back and issue a letter to you. If you feel that there is a non-compliance, even small non-compliance, please go ahead and get it compounded. Don't wait for RBI to find it out, because it will not be good once they find it out. And any returns, file it on time. Respond to all your notices. Stay happy. That's it. I think we are out of time, but we will spend some time on Q&A, and we should be. Sorry for being over time.
No, sir, you were very much comprehensive and very illustrative. So you have taken that much time. We will not regret for that, but definitely we'll spend some time for Q&A. What I will do is I will allow the participants to unmute themselves. Participants, you are free to unmute yourself and pose any query to Vivek sir, so that he will be more than happy to answer. You may also post your query in the chat box. And in the meantime, let me check if we have any queries in the chat box by this time. Previously, I thought I have seen 1 or 2 queries, but just give me a second to go through.
Hello,
Can I
sir.
speak, sir?
Yeah, one at a time, please. One at a time, please.
Yeah. My name is Shastri.
Yeah, please go on, sir.
Yeah, my name is Shastri. For my client who is a trading of coal, okay, they import material. Okay, while importing for our customers, there is some delay from the customer point of view, and we requested the supplier to delay the consignment. Shipment already done, and there is a demurrage charge from the shipper to the supplier. Okay,
Shipper to the
supplier, and shipper asked. Okay, supplier gave invoice to us. Same.
Yep.
And while remitting, bank is asking 15 CA CB.
Mm-hmm.
And when we are checking demurrage charge, there is some people are telling there is a TDS deduction, and they are not comfortable giving 15 CA CB.
Okay.
Can we do in 15 CA Part D, sir? Because this is a part of imports.
Actually, your demurrage charges also you are paying it to your customer, is that?
Yeah, we have to charge ultimately to the customer, but
supplier,
first we have to pay to supplier.
Supplier. Okay, so supplier actually paid demurrage charges to the shipper, and they have cleared it. And now you want to compensate or reimburse your this amount to your supplier. Supplier,
yeah.
It should be possible, sir, because it's an import payment. You can actually do it in 15. Not a problem.
15 CD, Part D, can we do? Part C has to be signed by CA. For that demurrage charge, there is no TDS, so they are uncomfortable for signing. What is the provision? 15 CA, Part C or Part D?
I'm not really sure about this particular thing because there is no invoice. See, one thing you may have a problem at FEMA itself is that when there is no invoice for this particular amount, you may have a problem on remittance itself.
Supplier gave invoices, sir. Supplier gave invoice.
They actually gave you the remittance, the demurrage part also separately.
Yeah, they gave demurrage charges details and they invoiced to us.
Okay, demurrage charge invoice that they have got also they have given, is that?
Yeah.
Okay.
Actually, 15C, if there is any TDS deduction, CA has to certify. In this case, since it is a reimbursement expense, no TDS applicable. And they don't want to give in 15 CA Part C along with the CA certificate.
Yes, sir. So it has to have a CA certificate, I'll tell you, because without you are not able to tell exactly whether it's a reimbursement or not, because you don't have the invoices that have been given by your supplier to say there's no income that is accruing to a non-resident. If you cannot substantiate that, please take a CA certificate.
Vivek, let me add something here. Pradeep here, Vivek.
Yeah.
Okay, so Shastri Garu, the question is whether 15 CB has to be given.
Yeah.
Okay, by the chartered accountant. The chartered accountant cannot, should not, in the normal sense, deny any issue of 15 CB because without 15 CB, the banker is not going to make any payment.
Okay.
Okay, so you need to give the concerned chartered accountant will have to give 15 CB, and if it is exceeding 5 lakhs and all, you have that conditions in 15 CB and 15 CA. So essentially, of course, we'll cover that tomorrow. But the point is, there is nothing that should stop from giving a nil certificate of withholding taxes.
Okay. Now, sir, another question. Demurrage charges, TDS applicable or not, sir? Generally, for dollar invoice, demurrage charges, is it taxable, TDS taxable or not?
See, okay, so of course, that's an elaborate discussion that we will be having. But let me tell you, we need to go step by step. Okay, whether it is falling within section 5, then you need to go to section 9. Section 9 talks about royalty and fees for technical services. Now, is it a fees for technical services or not is what you need to observe. Okay, and then you can go into the nature of payment is what you need to see. Once you are clear about the nature of payment, see, demurrage charges could be, you need to really look at the intention of the payment, the basic conditions of that payment. Once that is clear, and if it is falling in one of those one of those buckets. See, the idea is not to say yes or no to demurrages, whether it is TDS is applicable or not. As chartered accountants, we are expected to look at the nature of payment, and if it is falling in under the clause of FTS, then you have to deduct your TDS.
Okay.
Yeah, can I start my question?
Yeah,
sir?
please.
Okay, sir. Okay, fine. Thank you.
Thank you so much. Myself, Ankita Musani. I am from Hyderabad. And actually, I have lots of questions, but I can't ask you all the questions. I'll ask the very specific question. So one of my clients, they are providing some services to the office of a foreign company, which is in India.
Okay.
The client's is outside India, but they have some office in India where they want some servicing of the product. So basically it is a service. But the payment will be done by the foreign company to my client in a foreign currency. So
sorry, so your client is a branch of a foreign company.
No, my client is an Indian person, Indian company, company.
Okay.
Their client is a foreign company.
Okay.
And that foreign company have an office in India where they want some services to be done.
Okay.
But they will pay in foreign currency. They will pay from the foreign company to my client.
Okay.
So, because now whenever we receive the money from India or we pay money out of India, the banker is also asking some Excel sheet where we have to link import export with the payment and receipt of the foreign currency, right?
Yeah, obviously you will see when you are when the person who is paying you is the foreign client or the head office of your Indian client, right? So you would obviously invoice them, because once you get a remittance, you will have to link that remittance against the invoice that you have done, because RBI has the EDPMS system. So you will have to link that. So if you are not raising an invoice on your foreign client and money is coming from outside India, your banker will not even credit that amount to your account.
Okay, so what you advise is we have to bill to the direct foreign company from where the money is coming.
Yes, please.
But the services are given in India, so I have to charge them GST. I'm asking you something very different from the subject. But as per GST Act, we have to charge the GST. So then in the foreign invoice, shall I mention the GST portion separately?
No, if you mention the GST portion separately, obviously it will not be relevant for your foreign vendor anyway. But what happens here is, I think you can raise a consolidated invoice for that, because it's an export invoice at the end of the day.
Okay.
Those services are done in India. I agree, services are done in India, but payment is coming from outside India. You can still consider that as an export service.
Okay, sir. Thank you. And sir, one more question, just a quick question. You said some country's name. I'm not able to recollect the term you used, but Uganda is also one of the countries where the restriction about investment.
Yeah, non-cooperative countries. There is an elaborate list by FATF. I think there are close to 20-30 countries. Some of them really, countries which we know very well. They are there. If you are making investments in any of these countries, or if you are from an LRS scheme, that is not permitted. That list will be there in the FATF site. You can actually, before you are making an investment, you can actually go through. But majorly, if you see, Indian residents will make investments in, say, US, UK, Australia, Canada, and all, which are fairly free from these restrictions. But yes, it's always better if it's not one of these countries, it is better you go through FATF site. Okay,
sir. Thank you so much, sir.
Right,
and
sir.
You will be sharing your contact details, right, sir, at the end of the session?
Of course.
Yes.
I have already shared the PPT in the WhatsApp group. You please check it.
Thank you, sir. Thank you so much.
You get a mail of the PPT presentation.
Thank you. Thank you.
Sir, I'm afraid that we are completely ran out of time, and
Okay.
maybe if you are willing, we may take up the last question.
Sure,
And
please.
for the benefit of others, if you may permit them to text you or mail you, so that can you clarify the queries which may be posed by the other participants who could not ask you today?
Sir, I would suggest they mail you or send you so that you can consolidate and send it across.
Yeah, definitely. Friends, that's a nice idea. Whoever have your queries unresolved today, I may request you to send the mail to the Vijayawada branch, that is VJA branch of SIRC of ICA gmail.com. I will text it in the chat box now. And in the meantime, Vivek sir may take another question, maybe from anyone who comes forward. Yeah, please go on, sir.
Hello.
Yeah,
Yes,
please go on, sir.
Yeah, sir, an Indian born person who is an OCI card holder and also he is holding UK passport, who is a resident in India from the past 15 years. Can he purchase an agriculture land or plantation land with his Indian earned income?
You are a PIO, right?
Yes.
But you are resident in India, no?
Yes, resident in India, but I am holding UK passport and OCI. I am also OCI card holder.
No, you cannot. You cannot.
I cannot. Okay. Can I invest in an LLP which is already holding some agriculture lands?
No, you cannot. That is specifically prohibited. Any investment. See, FEMA has this rule that whatever is not permitted directly, you should not be doing it indirectly. So if you are not permitted to directly buy agriculture land, being a PIO, right? You cannot actually invest in either a company that has agriculture land or give even loan to someone who is doing agriculture. It's not like 1 lakh, 2 lakh loan, but significant loans. And you cannot even invest in any entity that actually has agriculture lands or plantations.
But
that is
the case is, sir, he is a resident from the past 15 years and he is settled in India actually, but he is having the UK passport and OCI card. Still, he cannot purchase agriculture land.
But still, he is not classified as a resident Indian, right? So, so is it that he will be able to? There's a different way. You mail me. I can suggest.
Okay, sir. Thank you.
Right. Thank you very much, sir. Vivek sir, for your elaborate explanation on various topics of relevance, which are very useful for us in our day-to-day practice. It's nice to have you with us at Vijayawada branch virtually, sir. We hope and we look forward to your association with our branch in the near future also, maybe in the future also. Friends, may I request all of you to pose your unresolved queries onto the Vijayawada branch mail, which I have just posted in the chat box. I will collate them and forward it to Vivek sir. Also, he will be happy to share his knowledge with you. And once we receive the reply from sir, we will definitely forward it from our end. Friends, thank you very much for your active participation. And may I also request you to join us tomorrow at 6 p.m. sharp. For now, good night. See you tomorrow. Thank you, one and all.
Thank you so much.
Thank you.